get stuck into all things investment committee now, and therefore I'd like to bring up some members of said investment committee. Davinia Rogers is here, Investment Services Director at SimplyBiz. Hello, Davinia.
Good morning.
We've got David Yarrow here, who's an investment consultant at Hymans Robertson. Welcome, David.
Morning.
And then we've got Pan Andreas from Defaqto, Head of Insight, and hello, Pan.
Hi, yes.
None other than Jim Thompson from Defaqto, Senior Investment Consultant. Welcome, Jim.
Morning.
Jim and Davinia out and about doing the rounds at the ESG workshops up and down the country at the moment, but taking a break from that to broadcast to the nation on all things investment committee. Davinia, talk me through what the investment committee is there to do and how does it do it?
Okay, so our investment committee is there to provide the governance and oversight across all the investment research that we make available through investment services. A key element of that, as we know, is the strategic asset allocations that sit at the heart of the advice tool, which is Centra. And as part of the investment committee's remit, we work with the members of the investment committee from Hymans Robertson and Defaqto to review those strategic asset allocations on a quarterly basis to ensure that they are delivering the outcomes that we expect them to deliver. So there's a kind of a twofold approach that we take: the strategic asset allocation monitoring and also the oversight of that research as well.
Okay. Now, remember, folks, you can ask your questions in this section because we are back live. So do tap away and I'll try to answer them. Pan, fundamental to all of this is making sure that some asset allocations are delivering the expected outcome that the Engage planning tool, Power Centra, tells the advisor and the customer that it's going to deliver. So that's the 1 to 10 risk spectrum or the low, medium and high sequencing asset allocations for retirement income. How do we ensure that happens? What is it how do you match the risk profile number 10 to the asset allocation?
Sure. Okay, so at the moment we've got an asset allocation for each of the 10 risk profiles, and we know that those asset allocations, when you apply the capital market assumptions that we get from Hymans, those asset allocations are close to the midpoint of each risk level. So that's where we are now, and that's where we've been for a while. Every quarter, and David may speak more about this, every quarter, Hymans update and review their capital market assumptions. So they look at the historic data for each of the asset classes, and essentially they apply an economic overlay. So let's just not extrapolate that historic trend, but let's apply some intellect to it and say, given what's happening in the world today, what's likely to change for each of those asset classes? So they provide us with a new set of assumptions for each asset class in terms of its return, its forward-looking volatility, and the correlation between all the different asset classes. We then put those into a test environment, and we look at the current strategic asset allocations using the new assumptions. Yeah, so that gives us an answer which we then plot on that risk scale. And if they continue, if the strategic asset allocations that we already have continue to stay close to the midpoint of each risk scale, then we're happy, we sign those off, bring them to the SimplyBiz Investment Committee to sign off as well, and off we go. If we see, though, that they're starting to edge towards the boundaries and they're no longer close to the middle, then we would go back to Hymans and work with them to get a re-optimized set of strategic asset allocations that are closer to the middle when applied to those new assumptions.
Okay, so David, let's get stuck into that. Whilst Pan's explaining the process of how it aligns with the midpoint, what actually is the bit that you guys do with those economic scenario engine and those capital markets assumptions? What goes into the model?
So the model at its heart is essentially taking historical information that we have a rich data set spanning decades. And essentially what we're trying to do is not make a call on what might happen in the future, because nobody can predict the future. But what we're trying to do is learn lessons from the past and plot the key variables that will persist in time. So a key input into that is volatility, forward-looking volatility. So we can see what's happened in the past and come up with an assumption, both for the short-term 1-year volatility, say, as well as a much longer period of time for 10 years. And it's that 10-year long-term forward-looking volatility, which is then used in determining ultimately where the portfolios sit in terms of the risk bands.
Okay, so then out comes the answer, or the model answer, and then there's the discussion about whether or not it's far enough to the centre or moving too far away, etc. Got a question here from Mamusium Capital. I apologise if I'm pronouncing that incorrectly. What plans does the investment committee have for some of the SAA's large cash holdings, if any? I guess that's a good segue into asking, is it a large cash holding, and if so, why? What is it? What is coming out of the model that suggests cash?
So it depends on what risk profile we're in. So, for example, some of the riskier risk profiles, 8, 9, 10, will have a limited amount of cash, say between 0 and 5%. Whereas clearly, if you're in a lower risk profile, by its very nature, you'd be looking to hold much more cash. So, for example, risk profile 2 will have about a third of the portfolio in cash. So these are how the SAAs are designed to be able to, in aggregate, at the portfolio level, deliver a particular risk as measured by volatility, by 10-year volatility. I suppose the one aspect to draw out is that, of course, a particular fund manager may at any one time not necessarily manage their portfolio exactly to that particular asset allocation. And so they may, particularly in the current environment where there's a lot of volatility, look to take more or less cash depending on how they view the markets going forward. So there was a session earlier around kind of the view on the current economic outlook. And we have seen, for example, some managers look to hold more capital in the short term, keep a bit of dry powder so that they can enter back into markets when they're a bit more calm. So that's the sort of overall concept. Okay.
Then having done the asset allocation bit within the committee and said, right, okay, we're happy that 1 to 10 and the retirement income profiles, the asset allocation is still appropriate. How is that then translated out into the world in terms of, I guess, the assessment of fund management, and then you've got risk controlled solutions as well, Davinia, up against that. How's that bit working?
Yeah, so and I'll take kind of the risk controlled piece first. So once the committee, once we approve any changes to those strategic asset allocations based on that information David's just talked about, we then deploy that information out to our risk controlled partners. And I'm talking just around risk controlled here now. Risk controlled partners are those partners who work with us to either adopt that asset allocation with a tilt, or benchmark against the performance of those asset allocations. So each of the risk control partners would then, in the first two instances, take a period of time to then adopt those strategic asset allocations and bring all their assets back in line with what we would expect as a client outcome. And the performance benchmarks through which those risk control partners who don't adopt the actual asset allocations, those will change to align with the new asset allocations. From a risk ratings perspective, I'm probably going to hand over to Jim here, because Jim could probably provide a bit more information in terms of the risk rating process that Defaqto undertake.
Go for it, Jim.
Yeah, of course. I was happy for Davinia to take that one if she wanted to. So the way we do it is we liaise with the fund managers and providers on a quarterly basis. So when they first come up and go through a risk rating process, we work with them very closely so that we understand their asset allocations, their philosophy, whether they're taking more or less risk than standard at the moment. And they present themselves in either a strategic asset allocation in the way that fund managers look at their risk positioning over the longer term, typically kind of 3 to 5 years, or a tactical asset allocation, which is what risk they're taking right now. And so when we first assess them and on a quarterly basis, we will ask them to map to Hymans Robertson's kind of 32, 34 asset classes and plot them onto the risk scale of where those risk boundaries are and where they come out. And So in consultation with the fund managers and through our investment committee and through SimplyBiz's investment committee, we'll have a level of comfort that they are sitting and we're accurately reflecting them on this risk scale. But clearly, fund managers can take lots of different positions over short term, longer term. They can change strategies, they can change benchmarks, they can change just their general view of the world quite quickly. So we need to ensure that we meet with them quarterly. They submit data to us. If they go outside of their bounds or risk or breach their risk boundaries, we'll have conversations with them. We'll ensure that we're comfortable that they're in the risk bracket, that they're comfortable with the risk boundary they're in, and any reasons they might fall outside of those. So it's slightly different to that risk control piece. So when SimplyBiz talks about risk controlled, they're working in kind of collaboration with Hymans Robertson to ensure that those products are staying within those boundaries. For non-risk controlled clients, they have more freedom to kind of move around those risk spectrums. But ultimately, as a business, we need to ensure that for the advisor base, that we're correctly assessing them at all times. So actually, if they are taking materially more risk or materially less risk and are going to foreseeably for the future, we'll need to ensure those risk boundaries change. And so part of our role and our team's role is to ensure that if they are making those changes, that we're accurately reflecting those in the system going forward. So it's very much in consultation with the fund managers, but also applying the asset allocations that are provided to us by Hymans Robertson and the fund managers and bringing them together in the system for the advisor base.
So, and this is a torturous analogy, but in my mind, the way I position all of that would be that the risk rating is a taste test to check that the fund managers work at this moment in time tastes like a risk profile 5 should. Whereas the risk controlled solution, well, they've kind of got the recipe. So they should be fairly, you should know it's going to taste quite like it, even if they've added a little bit of extra to it. Is that a fair enough analogy? All right. Should I drop that one?
No, that's good. I think it's just worth noting on there that the risk control partners are committed to remaining within those risk parameters, a 5 being a 5, etc. And we work as an investment committee very rigorously on a quarterly basis with those risk control partners to review that process. And it's also worth pointing out that within the new risk control analysis quarterly update, that where, as Jim mentioned, a fund manager may be a bit risk off or risk on, for risk controlled partners, that will be documented, and they will have opportunity for those risk control fund managers to put some explanation as to why they may be slightly lower within that volatility band or higher. So it provides some good insight for advisors to have the discussions with their clients.
Now, this is the important bit, I think, Davinia, because all of this, investment committees can happen and all of this pontificating at the back can go on. If it doesn't turn into something practical that an advisor can sit down and say, okay, that makes sense because this fund's doing that relative to what my client is expecting it to happen, it's all been for naught, really. So that document is there. Where do advisors go and find that?
So that document sits, it's actually a digimag, so it's quite interactive, and you can go within there and look at the different risk profiles. That sits within the investment committee minutes, which we make available post-meeting every quarter. And it also sits on our risk controlled investment services page. And what that document provides really is everything in one place. So it demonstrates that each risk profile, how each of our risk controlled partners are performing, not only against each other, but against those expected client outcomes that advisors are setting expectation with their clients. It also provides a snapshot in time at quarter end as to what each of those risk controlled managers what their positions are from a strategic asset allocation perspective. So it gives a bit of an insight into kind of growth defensive splits, the views that fund managers are taking. We have information on there comparing some style and size information, and also some kind of more specific fund commentary pertinent to the fact that these are risk controlled solutions and those partners are committed to delivering and sticking to these client outcomes that advisors are agreeing with their clients.
Okay, and outside of asset allocation and then risk control and risk rating, also on the IC's agenda is researched fund lists and an advisory model portfolio research list. So Pan, Jim, who wants to talk us through the high level methodology that's used in those aspects?
So the methodology for the research fund list is essentially is something that we've agreed at the SimplyBiz Investment Committee, whereby we look at what parameters are we going to use to measure the performance of funds, to either include them or not include them in the research fund list.
Yeah.
So we have a scoring mechanism, which, as you'd expect, given that we're giving sort of long-term advice, a lot of the weighting within that scoring mechanism is based on historic returns. We look at historic returns over 5, 3, and 1 year periods. We look at risk-adjusted returns. We look at assets under management. We look at the clarity and transparency of the fund that we garner from fund reviews. And we give all of those a weighting and a score, and we end up with a research fund list for each asset class. That research fund list essentially becomes the universe for funds that can be selected to go into the advisory portfolios.
Okay.
So there again, the advisory portfolios is really important to understand. There's no subjective decision-making or judgment going into those portfolios. What we're doing is building an algorithmic process, if you like, that says these funds qualify for going into the advisory portfolios. So the obvious criteria, again, are performance. So if, for example, we were saying, let's put some American equities into the advisory portfolio, you could, for example, say, oh, let's just pick the top 3 in the research fund list that have scored the best. But if you did that, you'd find that they were all holding the same stocks.
Yeah.
They were all doing best because they were doing the same thing. So that really doesn't make sense. It doesn't give you any diversification. So what we do is look at overlap. We look at style. We look at size. We look at a number of different things and make sure that we're not just using the same holdings. And then what we do is optimize for Sharpe ratio, optimize for risk-adjusted return for those funds to go into the portfolios. So we go through that process every quarter, we review it every quarter, and we create an advisory portfolio for every one of the risk levels.
Great. Pan, Jim, Davinia, and David, thank you very much indeed.